Alrighty, well, welcome everybody. My name is Manjri. I am a career advisor at the USC Career Center. I see some familiar names and some new names, so thank you for those of you that joined us in our last session with Ryan. As a reminder, if you have any questions, feel free to use the Q&A box. That is an option, or the chat as well. But other than that, I'm going to go ahead and let Ryan take it away.
Fantastic. Thank you very much. We're back to round two here for us here at the USC Credit Union at the financial literacy conference here set up by the Career Center here. So right now we're going to focus on credit card foundations, how to build credit, the importance of credit, and how your credit card is truly that foundation to get you started. So let's jump in with lots of great information that we have for you. There we go. Perfect. So first off is really focus on building credit early. It's really important to start now, and it truly is going to follow you in regards to all different aspects of your life cycle stages for you here. So, why is it truly important to build credit early? Well, first off, as we're all here at university, your employers are going to be probably pulling your credit when you apply for your job. Really important to note this. Your employers, typically are hiring you to manage their finances, to have an eye on what's going on. So they want to make sure that you have personal responsibility over your own financial management, because you could be doing that in a job for them. So take note, employers are pulling credit these days, making sure that you are personally responsible in regards to your own finances. In regards to, receiving a car loan, you're going to need a car. Typically, we have over 8 throughout our lifetime here, and you're going to likely need a loan for all that. So really important to establish credit early. Establishing credit is going to be able to give you the ability to receive financing, and most importantly, receive financing at a low cost of borrowing, so that you can borrow the funds and that it's not overly expensive. And then also a great point to note is in regards to renting an apartment. Your credit is pulled in all of these applications, and your damage deposit can be determined via your credit. And most importantly, your landlords are looking at your financial responsibility of bill payment. If you can't pay your bills on time, what are the odds that you're going to pay your rent on time? So really important to start building credit early. Credit is all about basically a track record and a history of repayment throughout your lifetime, and really assesses you as a risk to a financial institution, and will basically let them determine, what type of risk are you? Are you a low risk or are you a high risk? So really important to consider all these factors across the board. And truly, looking to establish credit right off the bat, what is the way to do so? Well, typically a credit card is your first best option to do so. And truly a student credit card is your first best option. A student credit card typically will have, a little bit more flexibility than a normal credit card in regards to its approval process. Most notably, we know you're a student. So as a student, guess what? You don't have a job. You don't really have an employer. There's no major income coming in. However, what we do know is you're being supported and you're going to school. So there's some type of income there that's supporting you. And that's typically how we approve a student card compared to a normal card. So really that student card is going to give you the easiest route of approval, because it's not going through the typical employment guidelines there. We're more looking at is, how are you being supported in regards to going to university? Another option, if you can't get a student credit card, is a secured credit card. This is your next best option here. And a secured credit card, in effect, is you are putting up cash security for a credit card. In effect, give me $500, I'll give you a credit card for $500. Over a period of time, showing that you have, you're using that responsibly, they can then look to release that cash security for you, and then you can graduate into a non-secured card. So two really great options in regards to starting: your student credit card, if not a secured credit card, putting up a cash deposit. And then also another really great one to start off is getting a small credit builder loan or a small personal loan, because establishing credit is basically just establishing that you're borrowing money and that you have that track record for repayment and you are repaying on time and using it responsibly. So in regards to kind of credit scores, what is it all about? What does it truly mean? Well, a credit score basically runs from 300 to 850, and it's truly revealing how much you are as a financial risk. And this number is basically, it's a risk rating. A credit score is solely a risk rating. So basically, anyone kind of below 300 to 560 is considered very bad, not managing their financial obligations, making, a tremendous amount of late payments or not paying at all, bad to fair, ranging from 660 up to 700. And we really all want to be focused on having credit scores above 700 in the good or excellent range, because in doing so, we're going to be able to have the ability to borrow money, and we're going to, most importantly, have the ability to borrow that money at a low interest cost. And that's going to be the really huge key here, because if the interest cost is too high, we may not be able to afford it. So we need that affordability, making sure that we have the best credit situation possible so that we can get that loan with the best interest rate possible. And then also, there's 3 credit bureaus here, which will all primarily have a different credit score. So we need to take that into account as well. We're going to look at them later on in the next couple slides, but those 3 credit bureaus are Experian, Equifax, and TransUnion. And they all have their own unique way of calculating their credit score. But in effect, the score itself all runs off of this table, noting, where we want to be is above 700 into that good category, and most importantly, getting into the excellent category. And this will take time, because your credit score is truly a reflection of your payment history. That's it. And as we noted, it's a reflection of your payment history. Here is a slide here which shows us how the 3 credit agencies are deriving that magic number to give you that credit score here. So as I mentioned, most importantly, it's just payment history. 35% of your credit score is solely derived off of, are you paying your bills on time? Do you have any lates within a 30, 60, or 90-day period? All of those 3 time periods are tracked on your credit report. When you're past due over 30 days, that's going to bring your credit score down. When you're past due over 60 days, that's going to pull it down even more. And then so forth when we get into 90 days. So truly want to make sure that we're focused on payment history and paying our bills on time. Typically, a 30-day late payment will pull your credit score down about 80 points. And it can take you about 2 years of solid on-time repayment to get your credit score back up to where it originally was. So really need to focus on paying your bills on time. And guess what? Your bills are always going to be due. So don't wait to the last minute to pay them. Pay them early. You already know it's due, so just don't get in the habit of making them at the last minute. Set them up as auto payments, so you know those payments are going through. Life is, full of lots of busy items these days, but we really need to make sure our bills are being paid, because this is what is affecting our credit score. Now, the second item within your credit score is amounts owed. This is a really important piece here, because it's very easy. You get a credit card, you know what to do with it, you make purchases on it, and you know that you have to make your payment on time. But what about the utilization of the credit card itself? You want to have typically about a 30% utilization rate on your debt facilities, and specifically your credit card, because what that is showing a financial institution is you are not reliant on your credit card. Most of us, due to the cash rewards and all the additional features credit cards have today, we run those credit cards up with all of our purchases and then we pay them off on a monthly basis. But we're extremely reliant on that credit card. So that actually will pull our credit score down. You really want to be in a position where you're utilizing the monthly limit of that credit card of about 30%. And that's really reducing your risk to the bank in which you're looking to borrow money from down the road, noting to them that you're not reliant on credit. You have cash, you can utilize cash, and most importantly, you have a budget in place. So you're not continually overspending and you're not running up a large balance on your credit card, even regardless if you're paying it off on a monthly basis. It's really important to stress, you want to keep it within a 30% utilization rate, because that is going to improve your credit actually quite dramatically, because you're not reliant on credit itself. And then the three other factors in regards to your credit score. 10% of that is made up of a credit mix. A credit card is a variable type of credit. It's based off basically a variable rate, and it has a fluctuating balance in which you can draw funds to borrow or not, depending on if you're using them. There's also fixed term loans in which you receive a full amount of money up front, and then you have a scheduled monthly repayment at a fixed dollar amount, compared to a credit card, which is going to be more based off of your outstanding balance. So credit mix, having kind of variable credit, such as a credit card, but also fixed term credit, such as a small personal loan, an auto loan, a student loan, that fits into that mix there. So really important to have a mix of credit, and showing the credit institutions that you can manage both of those two types of credit responsibly. 15% is on the length of your credit history. As I noted, truly your credit score and your credit report is just a timeline of your repayment history and the use of credit. So it's that length of credit that you have that is really important. How long have you had that credit card for? Has it been 5, 7 years? Well, that's really important compared to 1 or 2 years, because you have a much longer track record and established payment history on those cards, or on those cards that are held longer. So you always want to take note, if you are looking at closing down some credit cards, take note of what that credit history is. It actually may be more harmful to close that down than to actually not use it, or just continue to use it, for a small transaction now and then to keep it active instead of actually using it. And then 10% is in regards to new credit. Through your life cycle stages, do you have the opportunity to receive credit on a continual basis? And as noted, you will need that. You're going to always need to have the ability to borrow money to make a purchase. We don't have the money up front. So that's what the whole banking system is about, is to be able to give us money when we need it, and then pay it over a long period of time in regards to that repayment. So new credit in regards to auto loans, mortgages, personal loans, all these items in regards to new credit that you'll be receiving throughout your lifetime. So these 5 factors here are truly determining what your credit score number is going to be. And most importantly, as we noted, 65% of your credit score is focused on your payment history and how you're using it, and that utilization amount. So really focus on trying to utilize it about 30%, and don't be dependent on your credit card. That's kind of the key in regards to how we assess you as a risk when determining your interest rate for any product that you're looking for. Now, one of the great pieces of information that we have here for you today, and this is probably one of the most important pieces of information I tell to all the people in regards to the financial literacy presentations that I do. Annualcreditreport.com. This is a fantastic website for you and a great resource. It's just a great tool. So this is basically the only legitimate site that has been set up by the federal government with a mandate with really no strings attached. This is brought to you by the 3 credit bureaus, Equifax, Experian, and TransUnion. This is giving you the ability to get your credit report completely free from each of the agencies once per year. And really important for us to first off be aware of what information is out there about us on our credit report and actually having an idea of what it looks like. So first off, what I suggest to do is in just starting in to utilize this tool is really log in and get your credit report from all three credit bureau agencies right off the bat. Put them next to each other, see what the differences are. Really what we want to look off the bat is in regards to, is the information correct? Is your name correct? Is your birth date correct? There's lots of mismatches in regards to birth dates, in regards to the month and day, with everybody using different formats. And then as well, looking at, what are the credit facilities on those credit reports? Are they in fact yours? And this actually will help down the road in regards to identity theft, which we'll mention. But really get all three credit reports at once, take a look at all the information provided on those reports, make sure that they're correct, make sure that those debt facilities in fact are yours, and you'll take note of the payment history that's reporting on there. This is the key piece of information we receive at a financial institution in determining your approval for your request for a loan. This is solely going to determine what interest rate we provide you with, and as well with possibly the length of how long we're going to lend you money. So you want to make sure we're all in the best credit position possible so that we can receive the ability to borrow money. And once, as I mentioned again, borrow it at a low cost compared to a high cost, because within our budget, we may not be able to afford that high cost. So once you pull all credit reports, the first time you take a look, correct any information that's wrong about you that you notice, have an idea of what information is there on you. Then basically what you want to do is over the next year, you want to pull one of these reports every 4 months. And then that's going to help you in regards to identity theft, because you're actively always taking a look at your credit report. Most people don't know that they're a victim of identity theft sometimes until they approach a financial institution for a loan. And at that point in time, then there's an issue of why you weren't approved. And it comes up in regards to your credit report. Well, this item here. Well, wait a minute. That's not even something I am aware of. I don't even have that. I know nothing about that. Unfortunately, the fraudsters that are involved in this, they're not going to pay your bills for you, and they're not going to pay them on time. So you really have to take onus in regards to the environment that we're in now, in regards to the digital age of, it's not a matter of if, it's actually a matter of when your information will and can be compromised. So you really want to be in the driver's seat controlling that. So pulling your credit report at once, all in the beginning to understand it, and then after that, one every 4 months is going to allow you to keep an eye on your credit report. If something unusual pops up, guess what? You're monitoring that every 4 months by a different report from Equifax, then another 4 months later from Experian, then another 4 months later from TransUnion. And you can identify something right away if it pops up, compared to maybe a year or two later until possibly that you approach a financial institution for a loan. So fantastic resource and tool here. Please utilize it, annualcreditreport.com. This is probably one of my most favorite websites and tools that I can tell people about. And that really brings us into our discussion about credit cards and how credit cards are going to help you build and strengthen your credit over time, and truly what we need to be aware of in regards to credit cards, because this is just not an item to help us purchase items there, but it's vendors and companies are trying to entice us to spend more on credit cards these days. There's a ton of reward features out there across the board, and those are all incentives to get us to spend more, to spend over our budget. And then of course, for these companies to make money on the extremely high rate of interest that these credit cards are charging. So let's get in and talk about some of these key features that we all need to be aware of. So first off, just in regards to noting the difference that we have in how we can make our payment here, debit cards versus credit cards. Your debit card, truly is just withdrawing that money directly from your bank account. You can only spend the money that you have in your bank account. There's no monthly bill, there's no interest charge, and it does not affect your credit in any way. So a debit card, very easily, it's taking the money out of your account. It's just in effect just like cash for you. But it's the credit card, which is a little different. Funds are borrowed against your credit card. You can spend up to your limit, and you are expected, and we'll once again actually drop the word expected, you are expected and required to pay this money back, or it will affect your credit. It has a minimum monthly payment due. And this is kind of a trick with the credit card companies here, saying, what, feel free to spend up to your credit limit. We'll take it easy on you. You don't need to pay the full amount. We'll just, ask that you provide us with a small monthly payment. Well, that can basically charge you a ton of amount of interest over the time that we're going to look at. And the interest can be charged on those outstanding balances when it is not paid in full and it's not paid on time. But a credit card, because you're borrowing that money, it's going to help you build your credit history. And it's so important that it's used wisely, because a credit card is either going to do you tremendous good or it is going to do you tremendous harm. And it's all about your own personal responsibility in making sure that you're managing it correctly, because nobody else is going to help you pay your bills. You need to focus and make sure that's a key priority for you. So what are some of the pros and cons of credit card usage? So first off, it's extremely convenient. You don't need to have the money right away. You can utilize and make that purchase on your credit card. You can utilize, your statement to track your spending. There's lots of good budgeting tools within credit cards these days to identify, categories of what some of these purchases are falling into, so that you can quickly identify in your budget, are you over or are you under? The revolving credit is really equating to a quick loan when you need it. You don't need that cash tied up. You can utilize that credit card. And most importantly, the pro is it's building your track record of repayment, which in effect is building your credit and is going to put you in a better position going forward to receive lower interest rates for what you need. But some of the cons that we truly need to be aware of is it's too easy to spend beyond your means. You don't need to have any money in your bank account. You can just simply charge up that card left and right, and then you're going to be stuck at the end of the month. Fees can carry over if you miss a payment, or if you do cash advances. Really need to be aware of the fee structures. And then the high interest rate on credit cards, that can easily outweigh a benefit. Your credit card rates, as we're going to look at, in a few slides, can, range all the way up to, 25% interest. Well, if you're carrying your debt on your credit card, you're in a better position to move that over to a personal debt consolidation loan, where you may be paying somewhere in the neighborhood of 10 to 15% interest. So these credit card companies, they're all trying to get you to purchase, spend beyond your means, because it's just so easy to do so. So really be aware of that. Now, some items here to consider before applying, and really what should you look at? Because as I mentioned in our previous presentation, is we typically will get set up with bank accounts and financial institutions at a very early age. And then we really don't shop and determine what are the benefits and features of these credit facilities that I'm utilizing. So what is the interest rate? Is it a fixed rate or is it a variable rate? Are foreign transaction fees charged when you're using that card out of country? Because if you are traveling and outside the country, you're typically going to use a credit card over cash due to the security feature there. Will you be charged different rates for purchases versus balance transfers versus cash advances? So really take note, what are the benefits and features? Is there an annual fee on this card? And then what is the length of grace period, between your payment dates within statements of how long you're getting an interest-free period? These are all very important to determine right off the bat when looking at a credit card for yourself. And when applying, really some of those most important terms you want to look out for is annual percentage rate. We hear this term all the time, APR. What does this actually mean? Well, this is the actual cost of the credit indicated on an annual amount. This is the interest rate plus any additional fees that could be incorporated into that card to truly give you an idea of what is the cost of having this credit card. Balance computation method. This is the formula used by the credit card companies to determine your outstanding balance and what you'll be charged interest on during your billing period or billing cycle there. The financial charge, that's the cost of the credit for a particular billing cycle. Your fees, as we noted, is there miscellaneous fees being charged on your account? Is there an annual fee? Did you do a cash advance, which could trigger a fee? Was there a balance transfer that once again could have been a fee? If you made a late payment or you were over your limit because you weren't keeping an eye on what your credit limit was and what you were spending, you could be charged a fee there as well. And then most importantly, what is that grace period of time when paying off your balance without incurring any interest charges? So really want to take a look at the product in regards to the credit card and what are all the features that are on that credit card. And most importantly, we want to talk about the actual Credit Card Act. And this was brought up a number of years ago here and was implemented because, credit card companies were taking advantage of a lot of people. They were offering incentives. I don't know if you recall, but a number of years ago, credit card companies were pretty much every booth at every event out there. You could get a free t-shirt, a free blanket, something that was free to entice you to get a credit card. And then those features and benefits on the credit card, were enticing you to spend more. So they came in with the Credit Card Act to make sure that everybody is playing on an even playing field and that we as a consumer are protected in regards to what we're utilizing here. So they put in age restrictions, basically that no one could truly get a credit card unless they were at an age 21. However, if they could show that they had means of repayment, such as, utilizing a student credit card and having that support there, you can get a credit card all the way to the age of 18, but some of the normal rules noted 21. Notification requirements here. Credit cards now must give you basically notification 45 days beforehand if they're changing their rates and fees. They just can't sneak this up on you. They need to have standard payment dates to make sure that they're all playing within basically the same rules here. And most companies now must mail their credit card statements 21 days before the payment due date. Previously, this could have been done up to 14 days. And guess what? With the mail, that could have been received late, and then you may have had a late payment and charge interest. So now they need to make sure that they're having enough time to make sure that they can get you your statement. Specifically, what is the payment time? Noting that your payment is due on a specific date. If it's received on that date, it's treated as of that date. And then an opt-in over limit regulations here. Basically, credit card issuers were prohibited for charging fees on excessive amounts here in regards to over limit. So they've really had to play within a fair playing field here. So the Credit Card Act has really been great protection for us as consumers. And really one of the most important pieces it provided was the Schumer box. And the Schumer box is basically named after one of the senators that we have from New York there, Chuck Schumer, in which he truly had a bill here which made credit card disclosures very easy to read right up front. No more is there going to be, the hidden language, the small fine print here, because previously, as you can imagine, all this great information which you need to know about your credit card was probably font size, 2, and you could barely read it, and they were hoping that you couldn't read it. So guess what? You would get charged fees, you would pay more interest. So really all of this is spelled out in big writing and very easy to read so that you can make comparisons from different credit cards to see what the fees, what the features are. So the annual fee will be noted on there, the interest rate, big bold lettering, letting you know exactly what it is, what those fees apply and the interest rate are for balance transfers, cash advances, overdrafts, penalties, how to avoid paying interest on your purchases with those grace periods that we noted. So really all of your items right here you want to take in regards to the brochure pamphlet. When you're looking online in regards to a credit card, look at the Schumer box. That's where you're going to make your comparison and see all of the key items that you need to know. And in addition to that, how do we really need to focus on our credit card statements, and what are some of the terminology that we need to focus on? First off, you need to be aware and reviewing your credit card statements. Myself in the past, I was really bad at this. I would get my statement. I would say, oh, perfect. It's statement. Boom. I would throw it in a drawer. Wouldn't even open it. I would say, yeah, I know what I'm doing. Well, guess what? You don't. You need to be focused on your budgeting. You can spend money so fast these days with a credit card that you truly need to be aware. And, go into your online banking, look at your statement. I go into my online banking probably every week just to look at the transactions that I'm doing, making sure I'm aware where my money is going and making sure that I'm keeping it on track with my budget. So be aware in regards to your credit card statement. Review your due date. Review the minimum payment versus the full outstanding balance owed there. What is the new balance in there? What is the closing date? And what is the credit available? All really key items that you're going to see directly on your credit card statement. The due date's pretty easy. The minimum payment, that's the trick the credit cards want to say is, you know what, you owe $1,000 today, but don't worry. We're just going to be a nice guy and charge you $25 today. However, on the rest of that outstanding balance, we're going to be charging you an extremely high rate of interest. But don't worry, you can make small payments. But you know what? That small payment could take you years and years and years to pay off, which we'll actually take a look at an example next. And then noting, what is the credit available, which you have in order to spend versus what you have utilized on your outstanding balance and when that closing date and new balance requirements are. So really take a look at that credit card statement, utilize online and mobile banking to track your history of purchases so you know where your money is going, which is most importantly, so you can track that back to your budget. Now, as I mentioned, that credit card payment, very easy. In this example, you owe $6,000. But you know what? Don't worry. You can just make a small minimum payment. Well, as an example, if you were to make that small minimum payment, that $6,000 balance that you have on your credit card is going to take you 14 years to pay off. With the amount of interest that you're being charged, which could be up to 25% on your credit card, that outstanding balance that you pay over 14 years, is going to be in the several hundreds of thousands of dollars. And that's going to be well above that $6,000 that you originally borrowed. So, and to pay that off over 14 years is just, in effect, it's a waste of money. So really make sure you focus on your budgeting. As an example here, make the double minimum payment over that $6,000 debt. You're looking at about, you've cut your payment history on that down considerably. You've taken 10 years directly off that. It'll take you about 5.5 years to pay off. Or make your minimum payment plus $100. Easily, that's now reduced your time period to pay that debt off to 3.5 years. But if you do have credit card debt, look for a possibility. First off, is you don't want to get in credit card debt. You want to focus on paying that bill in full every month to the best of your ability. But if you do start by having a balance on that credit card, then look possibly for a debt consolidation loan where you can pull that money off the credit card, lock it up in a fixed term loan, and have a fixed monthly repayment at a much lower interest rate than your credit card. And, going back, all of this is about your repayment history when noting, your credit. So making sure that we have, it's being paid on time and that we are paying it and utilizing our balances on a low limit. So that kind of brings us to the end here. Some additional information in regards to financial education that we have here at the USC Credit Union for you through our Financial Focus series. You can find this directly online through our website at usccreditunion.org/students. Just right up in the right-hand corner, financial education, where we're here to provide you with lots of great tips and tricks across the board, and in which we have a whole bunch of online learning modules here for you, in which which we have kind of the basics to review all your financial basics. We have items listed here for financial education. Most importantly, which we've discussed today, is your credit and you, and how you can be prepared and handle some of these big transactions that you're going to need to have and rely on banks to lend you money down the road. Investing in your future, working in the real world. You can personalize these playlists. This just gives you an idea of what some of these look like. They're ranging from 2 to 7 minutes, interactive videos, lots of good stuff across the board. And, really focus on continually going back and doing these to just updating and brushing up your tactics in regards to, how do I manage my budget? How do I manage my finances? So lots of great tips and tricks in regards to our online learning modules there. And then also right next to that, we have our financial boot camp here for students. This is a great series in which you can sign up for via email. We're going to send you an email over 7 days with essential money topic tips to really put you in the driver's seat of your finances. So lots of great information here for you across the board at the USC Credit Union. And with that, we've pretty much covered the introduction of credit, why it's important, credit cards, and we'll open it up for questions.
Awesome. Thank you, Ryan. So one of the questions we had was, how long does it typically take to build credit? So do you start at an excellent score? Do you start at a baseline score and then build up from there? Or
yeah, fantastic question. In effect, you pretty much start at zero. So, the key is to get primarily that first credit card that gets your credit started. That will pull it up a little bit, and then it's continuing to make a couple purchases, keeping your utilization low, keeping that purchase transaction history going, and just keeping your bill payments on time. And then over time, your credit score will be, up to where we want it to be. So right at the very beginning, you start at zero. And then from there, in managing your credit over time, that score is then going to get up into the 600s, into the 700s, and get you going from there.
Cool, thank you. So we had another question about clarifying in regards to the annual credit report. So one of the things you talked about was, pulling it once a year, or, being able to pull it once a year, but then after that, being able to pull it, every couple months.
Yeah.
And so my understanding of that is because there's 3 different branches, if you pull one of the branch every 4 months, then that's fine. Or can you just clarify the difference between the once a year?
Yeah, absolutely. So you have your 3 different agencies, and you have access to each of those agencies, one report, one free per year. So we suggest to break it up over the year. So say the first into that year, the first one you'll pull is Experian. You've checked that one off the box. You've received your free credit report from them. 4 months later, then you're going to request from TransUnion. That's going to check that one off the box for the year. And then 4 months later down the road, then you're going to get it from Equifax. So over that period of time, over that year, you've received a report from each one of them, but you're staggering them over 4 months. And it's important in this day and age of identity theft to keep an eye on your credit report. As I mentioned, people typically don't notice these items until they ask for a loan. And at that point, it's almost too late. So if you can keep track of your credit report and see what's on that report, every 4 months, you're going to be much further ahead of the game should you be a victim of identity theft.
Awesome. Cool. So we had another question about interest rate and APR. So what's the difference between a fixed rate and a variable rate?
Yeah, absolutely. Great question here, because really important to note in regards to kind of any loan that you're going to receive. What type of interest rate is it? A fixed rate, you know exactly what it's going to be. It's going to say be 10% from today until the end of my loan, and I'm going to have a fixed monthly repayment schedule based on that interest rate and paying off that debt. Comparing that to a variable interest rate, that could be based off of the prime lending rate plus a spread. And if the prime lending rate goes up, guess what? Your interest rate is going to go up, and you may not have budgeted that into your forecast of saying, well, today my interest rate is at 6%, but because the prime lending rate is down right now due to the economic conditions that we're seeing, the only way that's going to go over time is it's going to go back up. So the cost of lending under a variable interest rate will get more expensive, looking down the road. So you have to factor that into your budget. Is my monthly payment, today $100. But if that interest rate goes up due to the prime lending rate go up, all of a sudden my monthly payment now could be $125. And you need to make sure that you're aware and you're budgeting for that. That's a really great question.
Cool. Another good question. So, what kind of transactions would you want to put on a credit card versus a debit card?
Hey, great question. On a credit card, I try to limit my utilization. So, in regards to doing that and trying to take advantage of some of the benefits in regards to rewards that a credit card has, is I primarily just put my groceries and my gas on my credit card. So that way I know it's just those purchases. Everything else I truly try to kind of do via my debit card or cash. So then I'm sticking to my budget and I know what I can spend versus what I can't. Because my credit card, it has a limit on there in which I can utilize it. But if I start utilizing it, I'm going to lose control of where my money is going and my budgeting. So I truly just try to keep, my groceries and my gas as transactions on there, typically because I also get double rewards points for those. So it's a great feature because I'm getting double points. Everything else, let me utilize my debit card for that. But it's kind of a decision of what works best for yourself. But make sure you are noting you're not running that credit card limit up to the max, because that utilization is a 30% determination of increasing your credit score for you.
Awesome. And then kind of piggybacking on that 30%, one of the questions was, is there a reason that 30% specifically is the optimal usage rate to build up credit? Like, kind of, where did that number
Yeah,
come from?
that's the number that the crazy mathematical calculation is determining at. And that utilization is completely really important, because as someone that is going to lend you money, I want to know how reliant you are on credit. Do I want to lend somebody that is completely reliant on credit? I may charge them more compared to someone that isn't. So, a great tip and trick is to put your credit card away. Don't use it, for a month, for a week. Utilize your debit card. Watch the money come in and directly out of your account, compared to a credit card is, 30 days later, I'll be making that payment. And I hope I have enough money to make that payment. So that's kind of a good trick, it's that utilization, and keep that utilization below 30%, because as a lender, I'm looking to determine you as a risk when you ask for money. And the credit score is helping me determine what type of risk you are and how heavily reliant you are on that credit, because you're asking for more credit from me. And if you're so reliant on that existing credit, I'm going to, think about giving you more credit and what that possibly could be. And maybe that's going to be at a higher rate than you previously had.
Oh, thank you. So going back to kind of credit score and starting from scratch. So if you're new to building credit and start at zero, is it possible to rent, purchase a car, et cetera? So what advice do you have to people that are, trying
Yeah,
to do
absolutely. It
things
can
like
be
that?
very difficult in
Mm.
regards to starting from scratch. And I can speak from very personal experience here. As I moved from Canada down to the US here about 6 years ago. I was a homeowner in Canada, had multiple car loans. I worked at a bank. So I was, I had great credit. I had the ability to get credit when I needed it. And I had the ability to get, a low option of financing because I had such good credit. But when I moved down to the US, I started at zero. So when I went to rent my apartment, they wanted 2 months worth of damage deposit, compared to somebody that had credit that only needed to put up anywhere between $500 and $2,000. So that was a huge, you know, heartbreak still to this day, which they have locked up in their account, for me to get a cell phone. I couldn't even get a contract, for a 2 or 3 year cell phone. They wanted me to pay up front for it because I didn't have credit. So really important to, get a credit card, and it's just a track record of your payment history. Get it, make a couple purchases, pay it off. Keep that transaction history going, and over time, that will have your credit score, increase. And then from there, you can look at adding mixes of additional types of credit in there, keeping your utilization low rates, which will expand your credit score over time, getting you up into that high 700 number, so that you have the ability to borrow money at a great interest rate.
Well, thank you. And this is kind of a follow up, and I don't know if you can say stuff to that or not, but someone asked, in that situation where you are starting from scratch, like, would having a cosigner help, or is that something that you see as common in that situation?
Yeah, absolutely. Co-signers can help. However, most situations, you should be able to receive a student credit card directly on your own. Noting when you are bringing a co-signer to the table, they can strengthen your application. But just note, if you're not personally responsible on that credit card, you can affect the credit of your co-signer. Moreover, your cosigner can sometimes affect your credit depending if they have access to that credit card as well, and they forgot maybe to pay the bill. So really when noting, it can be a double-edged sword. A cosigner can help you, but you, on the other hand, could cause them tremendous harm and you could limit their ability to receive financing. Most of the time we're looking at, kids getting their parents to co-sign for them. When, kids aren't responsible enough, they're not paying their bills or they're running up their credit card, and most notably not paying the bill, they're affecting the credit score of their parent. And their parents basically, have probably good credit and need it because they're getting car loans, they're getting home loans, and you may have jeopardized the rate of interest that they may receive from a low rate to a high rate because you had them co-sign on your credit card and you did not manage it responsibly, and in effect actually affected them. So you really need to be careful when anybody else is on your credit facility. It can, they can affect you, you can affect them. So you always want to try to start off right off the bat in regards to just yourself, and then from there, then look at the options in regards to a cosigner.
Cool. And then, kind of going along the lines of the student credit card piece, like, so the question specifically is, would you recommend any student credit card providers? And then my question is, how should you go about choosing between, like, what is the best way to
Yeah,
kind of choose?
great question. I'm not going to recommend anybody directly, but what I'm going to recommend is basically a comparison between a couple different options there. And as we noted in the presentation, via the credit card brochure or the information online, is they're going to have the Schumer box with that credit card. And that's going to be the key piece of information, which is going to have all the fees, benefits, and features directly on there in very large print, in very common language, so you can make a comparison in regards to each card and make that comparison. In the marketplace, there are thousands of different banks, there are thousands of different credit unions. So be aware of what option they're providing to you and make sure it's the best option for you, because that first credit card that you saw at 25% interest may have been the first one that you saw, but 25% interest is a huge rate on a credit card. There's options that you can get credit cards starting at 8.5% with no annual fees. So really take a look of what those benefits and features are and look for the Schumer box. That's going to be your key piece of information in regards to, is this the right credit card for me due to what the fees that they're charging?
Awesome. Yeah, that totally makes sense. So one another question that I think could be good to talk about too is just kind of like the impact of like opening and closing accounts, because especially accounts that have fees related to it. It's like should I keep it? Should I not keep it? So kind of things like that.
Absolutely, yeah. And really, what in regards to cards and accounts that are costing you a lot of money, want to take that into account. But also need to think about is how long has that credit history been established under that card. Now, I currently have a credit card that has $120 annual fee, and I just got hit with that just last week, and then I went, do I really use that card that much for a $120 fee? And man, that fee is pretty expensive in regards to me just utilizing this credit card, knowing that there is a lot of options out there. So I'm actually going to approach my financial institution and see if I can just change the structure of that card to a no fee annual card. I may lose some benefits such as reward points or something of that nature, but I don't see there's a need to have a $120 fee on that credit card that I'm not utilizing as my main primary card right now. So really just want to be aware of those key features, line up that Schumer box in regards to what is charging you and what those features are, and just really be aware. A lot of us, we don't think about shopping for financial services. This is probably a strange space for people. They pick one option, they go with it for the rest of their life. But This is in regards to the cost of borrowing over time. And we're looking at this cost of borrowing, whether it's a credit card with an outstanding balance, an auto loan, a home loan, it's going to be several hundreds of $1,000s over your period of time. So any, you know, any break in that interest rate is going to save you money over the long term. And that's really important. So that's going to be a key feature.
Awesome. Cool. So those are the main questions that we have. As we're coming to an end, are there any other last tips that you have in regards to credit or just anything that you wish you knew as a college student as well?
Oh man, holy smokes. Well, I wish I had something that you're doing here today, in front of me at that early age. I think that is the real key piece, because it was once I got out of university and started employment and, really being aware of my own finances, my own expenses, that was the shock in life that came. So take note of this time. Try to get all the information that you can gather. There's not a great source of financial education out there. You are truly on your own. So we have lots of great information at the credit union. The Career Center has lots of great information as well. Arm yourself with that information, because nobody else is going to help you out here on this. Nobody else is going to help pay your bills for you, pay them on time. You need to take that personal responsibility and on focus on that. And, coming back to your budget, this all comes back to budgeting, making sure you know how much money you have coming in at the beginning of the month, what has to go out during that month, and this is going to be with you for the rest of your life. There's no way around it. So you need to make sure that you're handling it responsibly, because you want to, and you will have a number of financial goals and dreams out there: car ownership, home ownership. And you need to get a loan for that. You don't have the money up front today. You need to amortize that over a long period of time and make those monthly payments. So it's all about credit. And honestly, it's all about annualcreditreport.com, because this puts the power in your hands. It's a fantastic tool, lets you see what information is out there and about you. And then as well, taking note of, hey, I see my credit card on there. Oh, I see my auto loan on there. Oh, good. I'm seeing no late payments on there. Or, oh, I do see a late payment. Oh, I need to get my budgeting in order, and I need to make sure that all this is paid on time, so it's not affecting and bringing my credit score down. So just noting, be patient, continuously focus on this. It's not going away. And if you do it, you're not, set it and forget it. This is basically continue to review it every few months, all throughout your life.
So we did get one more question, which I think is
Perfect.
super a good question. So they asked, why do people have more than one credit card? So do they all join to get, join to one credit score? Is it different scores? So just a little confused about concept having one credit card versus multiple credit cards. And
Absolutely. So first off, it's kind of, one of those items that we had within making your credit score is the mix of credit. So, typically people will have a few credit cards due to certain situations. I have one main credit card, then I have a backup credit card, because if my main credit card is compromised, it's closed until I can get a new credit card sent out to me. Well, I have a backup in case that happens. So I have the availability of credit should I require it. I also then have a third credit card. This is a very small balance credit card of about $500. And I utilize this to primarily make small online purchases. So I know this credit card is only going on certain things online. So if it does get compromised, I know what it was being utilized for and what I can do to alleviate that compromise of that credit card there. So I typically would say, 2 to 3 credit cards as max, due to kind of, your main primary, maybe a backup, maybe a small secondary card, but you don't need 5, 6, 7, 8, 10, 12, 13 credit cards. I've had friends open their wallets, go, hey, look at this. I'm killing it on the credit side. I've got 10 credit cards. Well, yikes, you're not really killing it on the credit side. You're actually killing your credit score, because do you need all of that credit? Are you making your payments? If you have all these multiple cards, are you in control of them. So really take note of that. Probably just a few, and then in regards to additional credit facilities, which will help you add to your credit mix and your payment history, are going to be a fixed term loan or a line of credit. Those are two great options that will help continue your payment track record on different credit facilities. And then a car loan, when you have that, that's going to boost your credit score. It was funny, as I mentioned, coming down here, zero credit. I got my credit card first. I had a track record of paying that over 2 years. I then went and got a car loan. And when I was at the dealership, the guy went, "Wow, you have no credit." Like, well, you have a credit card, but your age, that's what's going on here. Well, I moved from a different country. Oh, I got it. And he went, "Well, man, I tell you, after you have this car loan for a year, your credit score is just going to boost up, assuming you make your credit payment or your payments on time." That's always the caveat. And you know what? It has, because I added an additional credit mix into my whole portfolio of my credit there. So it's just over time, more and more credit facilities will come into your banking as you require them. As I mentioned, an auto loan, a small personal loan, maybe a debt consolidation loan, your student loans going into repayment. That's all going to assist you in regards to your length of payment history, your track record of different credit facilities, which over time will increase your credit score.
Awesome. Cool. Thank you. And we're at 12 o'clock now. So I think this is definitely a good time to end it there. Thank you so much again, Ryan, for joining us. I'll go ahead and stop the recording now. And